Hey, what's up, everybody? It is Monday, June 22nd. I just sent out the new edition of MMT Trader. If you want a copy, go to my website, pitbulleconomics.com, and sign up for a 30-day free trial. The link is right here in the description below. And don't forget to listen to my podcast. I'll be doing a new one tomorrow. So I want to talk about a couple of things. First of all, this whole thing about yield curve control. Yield curve control. Everybody's now going crazy about this yield curve control. It's all over that crazy lunatic blog, Zero Hedge. Let me just say this about yield curve control. Fed monetary policy, by definition, is yield curve control. There's nothing new. This is not a new thing. The fact that the Fed is a monopolist when it comes to setting rates, by definition, everything the Fed does is yield curve control. The setting of rates, even if it's at the very short end of the yield curve, controls the entire yield curve, because rates are merely a reflection of Fed policy over the term. What does that mean? A 10-year yield is the expectation of where Fed policy is going to be over that period, over 10 years. If the Fed says, hey, we're sticking at this level for the foreseeable future, then rates all along the curve will tend to converge down to whatever that policy rate is. If the Fed says, hey, we're going to raise rates now, then the yield curve will steepen because it will reflect the expectation of Fed policy continuing with rising rates over a period of time. So this is not something new. This is just silliness. This is ridiculousness, which is really what that blog is all about. I mean, that's just like a goofy blog. I have to say, once in a while they come out with news scoops. I don't know how they do it. They beat a lot of these very impressive news organizations like the New York Times and the Washington Post and the Wall Street Journal. So I give them credit for that. But the rest of the stories on there are just a bunch of hysterical nonsense. And this thing about, hey, there's going to be a gigantic rally because of yield curve control. You know, all Fed policy is yield curve control by definition, just due to the fact that the Fed is a monopolist rate setter. And that's it. So all rates along the term structure just reflect Fed policy over the term. That's it. So, I mean, just there's another thing that people are going to get all crazy about, and it's completely meaningless. Like, I'm seeing all these articles now about how, the Fed is juicing up. It's juicing. I remember I was even talking about some of these guys, they're crying in their soup because, what's the point anymore? Why should I even bother? I mean, the Fed is just going to push everything up. I said, well, if you know that, if you really think that, and if that's, in your mind, 100% ironclad guaranteed, then why aren't you buying? I mean, these guys are, no, please don't do it, Fed. We want to guess what's going to go on. And they're always, I mean, it's incredible to watch. It's hysterical to watch. All right, let me go over the numbers here, because I know, the market is holding up here very strong. We had another positive day. Didn't, at least with the Dow, didn't erase the decline on Friday, but the other indices did. So let's go over some of the numbers, and I'll tell you why I'm still a little bit of a skeptic here. But one thing that was positive in the recent banking data that we finally, and I think I mentioned this in my video on Friday, we finally saw for the first time in 13 weeks a turnaround, a rise in consumer loans, and particularly what I've been talking about, credit card and revolving credit. Why is that important? Because a lot of people spend using their credit cards or using their revolving credit accounts, and that was contracting for 13 weeks in a row. I said that was an indication of households' balance sheet consolidation, and I kept saying I want to see that turn around. I want to see that turn around. And it did turn around slightly. It was only a 600 million increase, which is in banking data terms, that's like a drop in the bucket. But it still was a rise from the previous 13-week decline. So that's positive. On the other hand, commercial and industrial loans, those are loans by businesses or taken by businesses, those continued to contract for the fourth week in a row. down 112 billion already in that contraction. All right, so that's not so good. Real estate loans, residential real estate loans, now at the lowest level in 8 months. All right. Bank residual, that's the assets minus the liabilities of the bank. Actually, you could just say bank net worth, bank wealth, okay? That is down to a 5-month low. We had 5 consecutive weekly declines in that. That is down to a 5-month low. Why is that important? Because bank residual actually is bank capital, and bank capital is the only constraint on bank lending. It's not reserves, okay? Loans create reserves, loans create deposits. It's capital that determines the lending power of a bank, and that thing now has lost 46 billion in the last 5 weeks. So that's, you could do it 10 times that. That's the ratio. That is 460 billion of lending capacity that has been taken away, reduced. It's not good for bank stocks, in my opinion. What else? The tax flows. Now, look, spending is blowing through the roof. It's growing at 33% year over year. That is unprecedented, maybe except for the World War II period. The deficit is 2.2 trillion. That's the biggest nominal deficit ever, but it's probably as about 17% of GDP right now. If we're using current estimates of second quarter GDP, that looks to be down about 46%. So that would put the deficit at about 17% of GDP. That's still not the biggest as a percentage of GDP. But, you know, that's a positive. Remember, the deficit equals the addition to the income and savings of the non-government. So if the government runs a 2 trillion deficit, by definition, the non-government, that's everybody else who's not the government, that's me, you, businesses, households, foreign countries, their balances go up by 2.2 trillion. So don't listen to what you hear out there about, oh my God, the deficit. No, if the deficit goes up, that's a good thing. But the problem is, so the spending is fine, but we have seen the spending mostly go into savings. The tax flows continue to contract. Employment and withholding tax deposits down year over year. I mean, we haven't seen that for 10 years. All right, you have to go back to the Great Recession to see that kind of a thing where year over year tax flows are negative. All right, so they're negative in employment tax deposits, they're negative in corporation income taxes, they're negative in total federal tax deposits. Now, I understand that tax filings didn't happen in April. And I understand that that is a factor in why we are seeing this big contraction year over year. However, that doesn't mean that tax deposits stopped completely. I mean, they're still deducting from payroll taxes. Some corporations are still paying income taxes. You know, I'd like to see at least some stability there. You know, even if it's negative, just stop falling every single day. Stop, but it's just falling. And by the way, I think my numbers kind of hinted at, we saw last week, weekly unemployment claims only went down by 58,000. That was basically nothing, because in the prior 4 or 5 weeks, the average weekly decline was 322,000. So my numbers were kind of saying, hey, you know what? Things are not really getting better on the job front. So we have that. And there's a whole bunch of stuff that I put in my report today. Oh yeah, if you want to look at energy, right? Look at crude oil inventories at a new all-time record high. This is despite a 2.6 million barrel per day cut in domestic production. We had a decrease in gasoline demand in the latest week. That was interesting. Why is gasoline demand going down? Weak exports, so that might say something about, you know, the demand outside the United States for U.S. product and crude. Low levels of refiner inputs, all right, they're coming up a little bit, but, you know, 13.9 million barrels a day, that's still way below. We were running above 17 million barrels a day in refiner inputs. What else? I mean, those kind of numbers, you know, and again, I understand that things are still opening up. We still, you know, it may be just the beginning. I may be not taking that into account as much as I should. But a lot of these numbers, I am looking at these numbers, for example, from the May 15th period, which was the end of the lockdowns in many places, compared to the lockdown period, which was March 16th to May 14th. And even there's no real increase. So it's not just that I'm looking year over year where you could say, hey, Mike, things are just starting to open up. Yeah, I understand that. And we're not going to get the same comparisons as last year because you still have a lot of things shut down. I mean, here in New York City today, we're only going into the second phase of the opening. But I'm looking from May 14th on, which is like when we ended the lockdowns in a lot of places, compared to when everything was shut down, and still not seeing any increases there. So I'm just saying, you know, market is very extended. And by the way, on that note with the market, it depends what gauge you look at. All right? For example, if you look at the AAII Weekly Sentiment Survey, that is super bearish. I mean, those investors are super bearish. And that says, hey, the market's just going to keep going up. It's eventually going to drag these people in. But if you look at the put-call ratio, that's the lowest in 6 years. I mean, call volume has been going through the roof. That is people getting like extreme hyper bullishness. So it depends what you look at, all right? But I look at that. I try to synthesize all this stuff together. Anyway, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. Get the information you need.